Hey everyone, hope you're all having a great day. Before we get started, I'd really appreciate it if you could drop a like on the video, and if you aren't already, be sure to subscribe for more in-depth stock analysis and financial advice. Today we're going to be looking at Faang, and if you aren't familiar with Faang, Faang just stands for Facebook, Amazon, Apple, Google, and Netflix. And also, as always, a quick disclaimer, you should always do your own research. You work hard for your money, and even if you don't, it's your money. You should know exactly where you're putting it. And I have a long-term investing philosophy, so keep that in mind as my outlook for these companies is forward-looking and future-oriented. Without further ado, let's get into it. So let's start with Facebook, one of my favorite companies in the world right now. You're going to hear that a lot today. I love the outlook and opportunities for all these companies. And as technologies get more sophisticated, these established tech giants are going to have a huge edge in development. And I'm not going to go into all these companies and do a deep dive today, but I definitely can. So let me know in the comments if you would be interested in seeing that. The question with the Faang stocks is never, are you buying a great company? All of these companies have amazing business models that are sustainable. It's reflected by their huge market caps. And the question becomes, are you getting these great companies at a great price and valuation, which is just as important. And now that I've gotten sidetracked, let's get back to talking about Facebook. So a quick overview of Facebook to remind or inform you of their biggest platforms and products. We obviously have the Facebook website and app, home to over 2.7 billion monthly active users, Instagram, which is home to over 1 billion active users, and WhatsApp, which has over 2 billion active users. And Facebook obviously makes its money through advertising on these platforms. I expect this ad revenue to grow as the future of advertising will be dominated by online platforms or apps such as these. Then there's Oculus, which isn't making a lot of money for Facebook right now, but keep me on the record, I think Oculus will become huge. Oculus is one of the only major players in the augmented and virtual reality space, and the possibilities for these technologies are endless. But that's a discussion for another time. So Facebook is down from $300 a few weeks ago. That's 17% from its 52-week high. And we can see analysts' average price target, or where they expect Facebook to be in a year, is $287, which is a little lower than what I'm expecting, but it's fair. So now let's take a look at some analyst expectations. EPS is expected to grow to 10.6 by 2021, which is a pretty reasonable estimate given their historical margins and expected revenue growth. So I have no problem with this estimate, and I'm going to be using this later. And by later, I mean this slide right here. So a note on one method of valuation that I use to come up with these price targets. So I look at the historical trailing P for the company, and then I'll come up with my EPS prediction for that year, kind of relying on what analysts have and some of my own intuition. And if I know these two things, I can see what the price would be trading at a year from now if the P stays around the same and earnings increase as expected. And I'm going to drop some valuation tutorials soon so I can go into more detail. But long story short, I like Facebook under 275 and love it under 255. If you can get Facebook at these prices, you should be happy. You just got one of the best companies in the world at a pretty fair valuation. They're trading at 252 as of Friday. So if you haven't already, might be the time to load up on some FB shares. All right, let's move on to Apple. You're probably familiar with the Apple ecosystem. You got the iPhone, iPad, MacBook, Apple subscriptions, Apple Watch, and only if you're cool, you got the AirPods. So Apple's taken a pretty hard fall from where it was at a few weeks ago. While Apple's an amazing company, this fall was pretty justified, and it was getting a little ahead of itself. Everyone say it with me, a stock split does not change the value or outlook for a company. That was just freaking ridiculous how much Apple stock was going up after the split. But thankfully, the price has fallen, and Apple's getting closer to what I think is a fair valuation. So analysts are expecting Apple's earnings to increase by about 20% for 2021. And Apple will most likely deliver. The fact that a company that's been around for as long as Apple has and is still growing earnings at 20% is incredible and a testament to management. So I'll give them the benefit of the doubt. I think a 3.87 EPS is definitely fair. And this might be the only Faang stock that I'm not buying just yet. That's not to say I don't love Apple as a company, as I said before. Their business model is great, but I like to get great companies at a great valuation and price. And I think a great price for Apple is under $95 or $90. And next up, we got Amazon, led by the richest man in the world, Mr. Jeff Bezos. And Amazon makes its money from its third-party sellers, advertising, Amazon Prime subscriptions, Amazon brand products, AWS or Amazon Web Services, and then a small portion from its subsidiaries. Amazon, from a logistical standpoint, is light years ahead of any competition, and is going to stay that way. No one can keep up with their distribution network, and talking about a competitive moat, that's just ridiculous. So also AWS is the leader in cloud services, which is going to continue to grow, and cloud is projected to be a trillion dollar opportunity. So that means Amazon's still plenty of growth to look ahead for. And we have a rare occurrence here. Amazon stock is almost never in the red this much. So anytime Amazon stock is down, it's usually a good time to buy. Earnings are expected to increase by 40% next year, and Amazon is barely touching the surface of where its earnings can be. Jeff Bezos has always prioritized growth over profitability, but Amazon is starting to flip the switch and focusing more on its profitability, which we can see by the increases in earnings. And I think you should meet these earnings expectations pretty easily. Amazon is a little under 3,000 right now, so I'm loading up on some Amazon shares. It's only a matter of time before we see Amazon back above $3,500. So anytime I can get it for less than 3,000, you better believe I will take some of that. So anyone that tells you it's too late, you already missed out on Amazon, just laugh at them. I don't know about you, but 40 to 50% earnings growth year over year, it sounds like Amazon is not done delivering value to shareholders. Okay, Netflix we got up next. Not a lot of overview here. Netflix is a subscription business that will have steady revenue streams of billions of dollars for years to come. I used to be skeptical of Netflix and its ability to continue to lead the streaming wars, but I'm now convinced Netflix will be just fine. If you've used some other streaming services, you've probably come to the same realization. Netflix seems to have the best selection of TV shows and movies, and on top of that, they have their original content, which is done really well. Netflix is down pretty significantly from its 52-week high. We saw it as high as $575. Now it's down about 20%. And I trust analysts' expectations for Netflix is pretty straightforward when estimating EPS for Netflix, given that subscription service businesses provide a pretty consistent income stream, which means estimates should be pretty accurate. And Netflix is nearing the price I would like to buy it at, but even at its current price, it's a pretty solid buy. We'll definitely see Netflix above 500 in the next few months. So if you get it for less than 465 or 450, you should be in good shape. Also, long-term, Netflix should be a staple in your portfolios that will continue to grow and collect this consistent subscription revenue. Lastly, we're looking at Alphabet, the parent company of Google. They got their advertising revenue from its search engine and YouTube, cloud revenue, and then some of their subsidiaries. We got Android, Nest, which makes smart home products. And now these last two are really intriguing to me. If you pay attention to the autonomous driving space, you have probably heard of Waymo, which is working on self-driving cars and taxis. And what is so intriguing to me is that Google obviously has Google Maps, but also they developed the navigation app Waze. Between all this navigation data Google's collecting and Alphabet's resources, Waymo is very intriguing. Tesla's all anyone is talking about when it comes to autonomous driving nowadays, which is well warranted, but don't be surprised if Waymo becomes a major player in the future. So Google's down from 1,725 a few weeks ago. So that's about a 15% slide from its 52-week high. And interestingly, given the decrease in ad spending, analysts are expecting earnings to decrease for the year, which we can see, which is uncommon for a major growth company like Google. But then by next year, analysts are expecting earnings to get back to normal and growing at a pretty good rate. So I think Google's a really good buy right now. Google Search and YouTube are two of the largest advertising platforms out there, and I'm very confident ad revenue will rebound strongly. I like Google under $1,550, and I'm adding substantially to my already large position if it gets under $1,400. I love what Google has going for it now with its advertising revenue, but I'm also very optimistic that Google Cloud will continue to grow. Some of these investments Google has made into companies like Waymo will start to pay off greatly. Okay, so to wrap it up, first off, what's going on? Why are the big tech stocks falling? There are concerns about tensions between the U.S. and China and worries about the sluggish pace of economic recovery. But I think one of the biggest factors is that some people are just selling off and taking their gains. A lot of people rode these stocks through the pandemic as stocks in the tech industry were thriving for the last few months and saw pretty significant gains. Some people may just be reallocating their portfolios. Some money managers are definitely getting into some of the companies that recently IPO'd. And like any market, it's just a matter of supply and demand. When people are selling and buying other companies, yeah, the stock price is going to fall for the companies that people are selling out of. And so let's get back to my initial question. Is it time to buy Faang? My short answer is yes. These stocks are in a bit of a slump, and you can get them at about a good a value as you ever can. There's not really any negative news pertaining to any of these companies, and their underlying business hasn't changed. They're just feeling the effects of a sell-off. So long term, if you love these companies, you might as well buy them now while they're lower than they usually are. And that's all for me, guys. Thanks for watching, and don't forget to click that subscribe button if you haven't already. Let me know in the comments what stock or news I should cover next, and take care, everyone.